Hello and welcome back to FX Pro Academy. Today, we're continuing our series on becoming a pro trader with Lesson 2. In this video, we'll focus on the essential candlestick patterns, how to identify them, and the key insights they provide for market analysis. By the end of this lesson, you'll be able to immediately apply these concepts to candlestick charts, allowing you to predict market trends, make informed decisions, and optimize your buy and sell strategies. Let's get started and sharpen those trading skills. In financial markets, we often refer to two major forces at play. One is the bulls, which represent the buyers pushing the price up, and the other is the bears, representing the sellers pushing the price down. These are basic terms you should become familiar with. In financial markets, there's always a battle between buyers and sellers. You can think of it as a constant tug of war between these two sides. Whichever side wins, the price moves in their direction. In trading, bulls always want the price to rise. On the other hand, bears aim for the price to drop. In candlestick patterns, we sometimes use resources from international sites. So, you'll often encounter terms like bullish for upward trends and bearish for downward trends. Just remember, bulls indicate upward movement, while bears signify a downward trend in prices. This distinction helps make things easier to understand. Some time ago, about 7 to 8 months ago, I realized something important about trading. Traders, in a sense, don't really contribute to society. They just buy low and sell high, without adding value. At that time, the market seemed to be going down, and I decided to sell off my assets. Then I waited for the market to decline as expected, and it did. At that moment, I wondered, who did I sell to? I sold to people buying at the top, right when I was selling. So, in a way, they were the ones buying at the peak. I felt a bit guilty for those buyers who bought at the top. What value am I adding? I started questioning whether I should continue trading at all. If my gains come at the expense of others' losses, I felt uncomfortable with the thought. But later, I came to a realization. I was wrong to think that way. Yes, it's true that if you profit, someone else loses. But that's the nature of markets. You're simply participating in the system. So, instead of overthinking, just remember, when the price is low, we buy. When it's high, we sell. It's that simple. No need to overcomplicate things. I hope this mindset helps you. Now, back to our lesson. Today, we'll continue our journey by exploring key reversal patterns. These are some of the most common candlestick patterns. These common patterns are easy to recognize. They often appear by themselves, and we can identify them quickly. You don't need to see multiple candles to spot them. A single candlestick can give you all the information you need. In the next lesson, we'll discuss candlestick pairs and combination patterns. These paired patterns can give us a clearer understanding of the market's direction. But today, we're focusing on individual candlestick patterns. Let's start with the standard candle pattern, which we often refer to as the standard candle. Next is the Marubozu candlestick. After that, we have the hammer candlestick. It's important to familiarize yourself with these English terms, as they're used frequently in the market. Then, we have the inverted hammer, and next is the hanging man candlestick. This pattern is named because it resembles a hanging figure. Next is the shooting star pattern, which looks like a shooting star in the sky. Then we move on to the doji candles. There are several types of doji candles. We have the standard doji and long-legged doji, which is also referred to as Dragonfly Doji. There's also the GraveStone Doji, which looks like a gravestone in its shape. Lastly, we have the gap pattern, which isn't really a candlestick. It's more of a price gap between two candlesticks. Today, we'll cover these patterns. For those of you familiar with these already, consider this a quick review. Now, let's take a closer look at the standard candlestick pattern. The standard candlestick is one that clearly showcases both a candle body and wicks. It consists of both an upper wick and a lower wick, reflecting all necessary price data. This includes the highest price, the lowest price, the opening price, and the closing price. In the case of a red candlestick, it indicates a bearish market, where the closing price is lower than the opening price, signaling strong selling pressure. A green candlestick, on the other hand, signals buying pressure, where the closing price is higher than the opening price, representing an upward movement. Now, when you see a long candlestick with a short wick, this indicates a dominant buying or selling force in the market. The short wick means there's little volatility around the opening and closing prices. This suggests that the market may continue in the same direction. For instance, this could indicate a continued upward trend or, conversely, a continued decline. That's why it's crucial to carefully analyze these patterns. If you spot such a green candlestick at the end of the day, it's often a signal that the price may continue rising. However, if you encounter a long red candlestick, it might signal a further drop in price. This could be an indication to consider selling. Imagine you return home and see that the price closed significantly lower. That could suggest the market is likely to continue declining tomorrow. In such scenarios, it may be wise to secure your profits at this point. These patterns often give a clear indication of whether the trend will persist. Now, let's move on to the second type of candlestick, the Marubozu candle. The Marubozu candle indicates that the closing price and the highest price are equal, and the opening price matches the lowest price. This applies to both bullish and bearish candles. This candlestick signals strong upward or downward momentum, even more powerful than the standard candle pattern we discussed earlier. It represents an extremely strong buying or selling force, making it one of the most decisive signals in the market. The Marubozu has no upper or lower wicks, which shows there was no hesitation or volatility during that period. It's just pure buying or selling. Now, if you're already holding a position, say you bought in earlier and the price has risen, it might be tempting to sell, but with a Marubozu candlestick, there's a high probability that the price will continue rising. So, don't rush to sell, thinking it's the peak. Many traders mistakenly believe that when the price climbs sharply, it's time to sell. If you're feeling bold, you might even consider adding to your position, because the odds are high that the price will continue to rise. When you spot a Marubozu candle, it often indicates a strong trend continuation. On the flip side, if you see a Marubozu in a downtrend and the price closes significantly lower, this is a clear signal to sell. Don't assume it's hit the bottom. Even if the price has dropped substantially, the market may still have room to fall. Thinking you've caught the bottom can be a costly mistake. Never assume a significant drop is necessarily the bottom. Even if the price has fallen by 10%, the decline may not be over yet. Today's bottom could very well become tomorrow's resistance level. Keep in mind that today's low can easily become tomorrow's high. So, be cautious and avoid rushing into trades without carefully assessing the market trends. Alright, let's take a look at this illustration that highlights the Marubozu candlestick. Here, we can see an example of a Marubozu candlestick, characterized by its long body. In some cases, even if the wick is very short, it's still considered a Marubozu. This is because the wick is negligible compared to the body of the candle. The shorter the wick, the stronger the trend. This shows a very powerful buying or selling momentum. It's one of the strongest candlesticks. So, this is a classic Marubozu pattern. Now, imagine you see this candlestick today. You might consider taking profits or cutting losses here. Selling at this point could be wise, since there's a strong possibility the market might continue to drop tomorrow. This way, you could save yourself from potential losses. Next, let's move on to another Marubozu example. Here, you can see the price has dropped significantly. It's likely to continue decreasing tomorrow as well, reaching a new low. We'll cover these additional candlesticks later. All the candlesticks featured here are part of today's lesson, so stay tuned. Now, let's look at this uptrend. Here we have a Marubozu candlestick. This pattern indicates a strong bullish momentum. Let's assume you bought somewhere around this level. Let's say you entered the trade right in the middle here. As you see the price rising to this point, don't rush to sell just yet. Don't assume it's going to reverse just because it's climbed a lot. With a pattern like this, the price is likely to keep rising. So, hold on, it's showing strong bullish momentum. And as expected, it continues to rise until it hits this level here. But once you spot this long red candlestick, you know a drop is coming. And this follows a typical pattern. From here, it continues downwards. Now, let's move on to the next candlestick pattern, the spinning top. The spinning top candlestick, also known as the reversing candle, is a key signal of market indecision. It seems we didn't mention this pattern earlier in our list. So, let's explore it now. Spinning top. One of the main characteristics of a spinning top is its small body. The body is much smaller than the upper and lower wicks. Both wicks appear on either side of the candle, and the body is relatively small. The wicks are usually at least twice the length of the body. This is the defining feature of the spinning top. Long wicks above and below the body. As you can see in this example, sometimes the lower wick can be longer than the upper wick, or vice versa. It varies. But the main thing to remember is the small body and the long wicks. That's the hallmark of a spinning top. Spinning top. It often appears to signify that investors are indecisive between buyers and sellers. They are unsure whether they should buy or sell, which means the pattern reflects indecision among investors. Investors are uncertain whether this is the right point to sell. Buyers, on the other hand, are unsure whether to buy more or buy less. This highlights investor hesitation. Now here, we see a long green candlestick. After this long green candle, investors are very hesitant, not sure whether to buy or sell at this point. Hesitation, indecision. It's commonly advised, and this is not my personal advice, but gathered from various sources, that one shouldn't buy or sell during a spinning top formation. The reason is that it signifies indecision. We can't predict whether the price will go up or down. In these cases, it's best to avoid making decisions based on a spinning top candlestick. Avoid buying or selling because it reflects indecision. We won't know whether the price will drop or rise. After a period of hesitation, the price tends to rise. As you can see, it goes up. But here, there's hesitation again. And after that hesitation, the price drops. Spinning top. A spinning top candle won't help us catch the top or bottom, but it helps us recognize that the strength of the upward movement is weakening. If the market was rising strongly, the spinning top indicates that the upward momentum is fading. It's no longer as strong. The same goes for downward trends. When prices are dropping, they drop sharply. If a spinning top appears, it signals that the strength of the decline is weakening, and investors are hesitating. When the market is falling and a spinning top appears, whether the candle is green or red, it's the shape that matters, not the color. Red spinning top or green spinning top. The important thing is the shape. Here, as you can see, the market is falling. We see the spinning top, and we're unsure if the price will drop further. Eventually, the price decides to continue dropping. The bottom is right here. Alright, next, let's move on to the next candlestick, the hammer. The hammer candlestick looks just like a hammer. You'll know it's a hammer when it appears at the bottom. When it shows up at the bottom, we call it a hammer. This pattern is often used to signal that the price has reached its lowest point. It's a sign that the market may be nearing its bottom. In stock markets and financial trading, like Forex, the price doesn't fluctuate wildly. Movements are usually steady day by day. That's why traders rely on the hammer and the candles around it to determine if it's truly the bottom. But in markets like crypto, where price moves are extreme, you'll need to rely on additional technical indicators. I'll cover these indicators in future videos. For now, just keep watching this series and you'll gain a deeper understanding. With daily practice, you'll become a pro. Now, back to the hammer. This is a signal of a potential market reversal. You'll see the market drop. And when it forms a hammer, the price may rise again. Remember, the hammer is designed to hammer down the bear. The bear pushes prices down, but the hammer hits back. Think of it this way. The hammer is there to crush the bear. Bears drive prices down, but the hammer comes in to stop them. It's like smashing the bear with a hammer, and the bear doesn't stand a chance. Now, here's a guide to resistance levels. Once the resistance level is broken, investors start buying. What happens is this: investors might hesitate at first. They know this might be the bottom, but they're not sure if it's a true bottom or a false one. Once the price breaks through the resistance level, they make the decision to buy, and they buy here, not earlier or later, but right at this point. Because nobody can know for sure where the bottom is, they wait for a clear sign of recovery before buying. Don't buy when prices are falling. They could keep dropping. But once the price rises and breaks resistance, that's when you buy. We'll cover resistance and support in detail in future videos. So don't worry, we'll get to all of it. For now, know that when resistance is broken, investors start buying immediately. Alright, moving on, here's the chart where we see the hammer pattern. This is the hammer. Sometimes, it doesn't have an upper shadow, or the upper shadow is much smaller compared to the lower shadow. That still qualifies as a hammer. Alright, now, the hammer, whether it's black, green, or red doesn't matter. The color isn't important, as long as it's a hammer. Now, as you can see here, these images are not drawn for fun. They are based on real market movements. In fact, these are actual screenshots, captured from real market data. They aren't just illustrations or theoretical models. Alright, let's continue. Moving on. Here's the hammer. The market is in a downtrend. Then it meets the hammer and reverses upward. Okay, got it. The hammer usually appears at the bottom, right at the market low. It always forms at the bottom, and it wipes out the bears. Bears pushing the market down get smashed by the hammer. Then, the market goes back up. Next is the inverted hammer, also known as the upside-down hammer. This inverted hammer is also used to crush the bears. Remember, a hammer is always used to smash the bears, like this. The selling pressure pushes down, but the hammer hits. When the hammer appears, the market may slow its fall and potentially rise. Exactly like that. This signals a reversal, indicating the market is ready to go up. Alright, the hammer. This one is an inverted hammer, while the other one is a standard hammer. Just remember, whether it's inverted or standard, both of them appear at the bottom. They help us identify that it's a bottom and are used to knock out the bears. The bear trend is going down, and we hammer it out. After hammering down the bear, the bulls take over. The bulls win, and the price moves upward. The bulls rise, and they rise strongly. Let's review. After it rises up to here, it encounters a spinning top. The spinning top shows some indecision. Then, it continues upwards. It keeps going up. Just like here, sellers encounter a spinning top, feel uncertain, and then decide to buy again, and it goes up. Now, the hammer helps transition to the next candle. The hanging man. It's a candlestick pattern that resembles a man hanging. This pattern is used to eliminate the bulls. The two hammers we mentioned earlier are for dealing with bears, but the hanging man is specifically for taking down the bulls. Notice how the hanging man resembles the hammer pattern. It's quite similar to the hammer, but remember, the hammer is always found at the bottom. while the hanging man appears at the top. When prices are rising, and you see this pattern, this is the hanging man, not a hammer. If prices are rising and you spot it, this is a hanging man, not a hammer. But if prices are falling and you see a similar pattern, then that's a hammer. So, the hanging man takes down the bulls. The bulls push the price up aggressively, but at the top, the hanging man pattern signals a reversal. It essentially hangs the bulls, bringing them down, and when that happens, the price will start to fall. This pattern is a clear signal that the market is about to reverse downwards. Both the hammer and the hanging man indicate a bearish reversal. However, the hanging man appears at the top. Here is the chart we're analyzing. As you can see, we have a running man candlestick. The running man forms at the peak of an uptrend, and it signals a potential market reversal. Moving down here, we see a hammer candlestick. The hammer also indicates a market reversal. Both the running man and hammer candlesticks give us clues about potential market movement. Now, let's take a closer look. The hammer here, notice the small body. It has a relatively small body compared to the shadow, and the shadow, or wick, is long. The wick is at least twice the length of the body, which is key to recognizing a hammer or hanging man candlestick. So, both hanging man and hammer candlestick share this characteristic, a small body and a long wick, at least twice the body length. Just be sure not to confuse it with a spinning top, which has a different structure. The body of a spinning top is more balanced, with wicks on both sides, unlike the hammer structure. With the hammer, we focus on one long wick. Here is another example of the hanging man pattern. The price was trending upwards. Then we encountered the hanging man with this very long wick. The longer the wick, the higher the chance of a market reversal. Remember, the wick needs to be at least twice the size of the body. Keep that in mind, at least twice. The wick should be twice the length of the body. In this case, it's much longer than the body. This indicates a strong potential for reversal. Here, you can clearly see that, after the hanging man, the market reversed sharply. You can see how strong the reversal is. The market dropped significantly after encountering this pattern. Then we see it reversed again, moving further down here, and at the bottom, we also see an inverse hammer pattern. This indicates the market is now starting to move back up. Next, let's move on to the next type of candle, which is the shooting star. Shooting star candle. This shooting star candle is similar to the hanging man. It appears at the top, at the peak of an uptrend, signaling a reversal trend. The shooting star candle looks similar to the inverted hammer. This candle can be either green or red. It can be green or red. Either is fine. The color doesn't determine the name. It's the position that matters. The position gives it the name. That's the shooting star candle. It resembles the hanging man candle. And just like the hanging man, it is very similar to the hammer and inverted hammer. The hammer and inverted hammer candles, they are similar. But hammer candles appear at the bottom, while the shooting star and hanging man appear at the top. So, the hammer candles appear at the bottom, while the shooting star and hanging man appear at the top. When they appear at the top, they signal a reversal. When they appear at the bottom, they also signal a reversal. At the top, they indicate a market peak, while at the bottom they signal the market has found its bottom. Let's continue here. The price is rising. You can see a setting star here. This wick may be a lot smaller than the upper wick, so it's considered negligible, and thus it's counted as a setting star. Do you get it? If the upper and lower wicks are equal, like here, where the upper wick and lower wick are equal, it's a spinning top. This is a spinning top candle. On the other hand, if one wick is significantly longer, like this, we consider the longer wick. This is a setting star, located at the peak of a price rise, indicating that this is the top, signaling a price reversal. Additionally, if the wick is longer, it indicates a stronger reversal. going down here, going down. You can see the candles we've studied. This is a spinning top, representing the indecision of investors earlier. Next, we move on to another type of candlestick, the doji. The doji has a unique characteristic compared to other candlesticks. That is, its opening and closing prices are the same. The opening and closing prices are equal, so the candlestick doesn't really have a body. There are several types of doji candles, such as the Doji Star. The name translates as Star Doji. Then there's the long-legged Doji, also known as the Dragonfly Doji. It's named that way because it resembles the shape of a dragonfly. We also have the GraveStone Doji, which looks like a tombstone. It visually mirrors the shape of a grave marker. Another type of doji is simply a horizontal line, without any wick. It indicates that the market is essentially flat. Now, let's go deeper into the different types of doji patterns. The doji, like the spinning top, indicates indecision in the market. While the spinning top has a body, albeit small, the doji essentially has none. This could signal indecision among investors. It may also reflect weakening buying or selling pressure. The once strong buying or selling momentum has faded. It may also signal a potential market reversal. This could indicate a bottom or a peak in the market. Let's dive deeper into the analysis. Here, you can see this doji candle. Now, this could also be considered a spinning top or a doji, because its body is so small. It's classified as a doji candle. This indicates investor indecision. It could signal a potential reversal, but not always. It's just a possibility, not a certainty. Keep that in mind. So, we see a strong downward trend that stalls for a moment, then continues downwards, but it could also reverse upwards slightly. However, it gets interrupted, signaling that the selling pressure has significantly decreased. The strong selling is fading here as well. It signals a potential reversal, but again, it's just a possibility. Over here, we see an actual reversal. While this case is only a possibility, ultimately, it did reverse. You can use the doji candle to gauge whether the market is likely to reverse. Some risk takers might jump in, thinking they can gain big. They might buy here, but I don't recommend it. I don't advise taking risks in situations like this. These are situations where, without solid knowledge, it's unwise to take chances. You shouldn't gamble on such scenarios. Just like with spinning top or doji, or long-legged doji, don't buy here. Instead, wait for the next few candles to appear. Based on those, make your decision to buy. You should only buy when you're 80 to 90% confident. If you're highly certain, then it's a good buy. Otherwise, it's like catching a falling knife, and that's risky. Risk-taking can be rewarding, but it can also be dangerous. Alright, let's continue. Now we'll go into more detail about each doji candle. The Doji Star is like a star in the sky. It resembles a star. It can appear at the top or bottom of an uptrend or a downtrend. There's a tip. If the distance between the Doji Star and the closing price of the previous candle is large, the stronger the reversal signal. The bigger the gap, the stronger the chance of market reversal. Here's the closing price, and here's the body of the doji candle. The larger this gap is, the higher the chance of a reversal. This shows indecision, but if this doji wasn't here but up here instead, it would signal a much stronger reversal. Right, you get it? If the gap is larger, the chance of reversal is higher. Understand? Let me say it again. If the gap between the closing price and the body of the doji is bigger, then the reversal chance is higher. If the gap is small, investors are still very uncertain, but if the gap is large, the next candle will likely show the decision to sell. Vice versa, the bigger the gap, the higher the reversal probability. The bigger the distance, the stronger the reversal. Alright, let's move on to the long-legged doji. The long-legged doji sometimes represents indecision among investors. It could signal a reversal. But we shouldn't sell too early here. Even though there's indecision, we don't know if it'll continue rising or fall. It could rise more, and selling now might be too soon. Wait until after this candlestick closes. For example, if this is a support line, once the support line is broken, the support level, when the support level breaks, it signals that sellers are pushing past that support. At that point, you should sell here. You may lose a few percent here, but it's just a few percent loss. When you see this candlestick, be cautious. You'll lose a few percent here, but this is an opportunity cost. It could still rise more. What if it rises to here? Selling early would be unfortunate, right? So, you're giving up this gain, accepting the loss. But that's part of opportunity cost. So, you would sell here. Once the support line breaks, sell at this point. This is similar to the buying strategy. You pin down here slowly before buying. Don't buy here, it's too risky. Wait patiently for the right time. Here is a support and resistance line. This is the resistance line, and when the price breaks through this line, the resistance usually doesn't let the price cross, but when it does, we know it's broken, so it will likely go higher, and we buy here. That's when you should buy. Got it. Don't buy below this point, as it can drop. The price might fall lower from here. Alright, let's continue with the chart. As you can see here, this is a Marubozu candle, showing strong upward momentum. The price keeps rising, and it continues upward until it encounters a spinning top candle, indicating investor indecision. Following that, we see a long-legged doji, which also reflects indecision. At this point, let's assume this is a support line. Once the price breaks below it, we decide to sell here. We sell because the trend has reversed. It's already reversed, and the price will continue falling. So, we sell at this point. After selling, you can see that the price continues to drop. This is the characteristic of doji candles. Next, we have the GraveStone Doji. The GraveStone Doji. The GraveStone Doji resembles the inverted hammer candle. Its nature is very similar as it appears at the peak of an upward trend. It appears at the peak of an uptrend. So, when the market rises and encounters a GraveStone Doji, you can predict that the price will reverse here. The GraveStone Doji is one of the most notable candles. The GraveStone Doji is like a hammer, an inverted hammer, hanging man, the suffering one, shooting star, the falling star. These candles signal the top and bottom of the market, while the doji and spinning top represent indecision. You shouldn't buy or sell hastily when you see these. Here, we can see a GraveStone Doji. As it rises and appears here, it signals the potential for a market reversal. Alright, moving on to the next candlestick. The Dragonfly Doji, also known as the Dragonfly. Dragonfly. The Dragonfly Doji is quite similar to the hammer. It's a doji, but resembles the hammer shape. If we add more to the illustration, it becomes a hammer. Typically, hammers are found at the bottom of the trend, signaling a potential reversal. It indicates strength to reverse. The dragonfly usually appears at the bottom. Instances where it appears at the top are very rare. As for buy and sell decisions, you should apply the same principles as with other candlesticks. You should wait for the resistance line to break before deciding to buy. Don't jump in too early, even though. Here it is. You can see the Dragonfly Doji at the bottom, right. See, the price is dropping, and here, That small wick on the top, we can ignore it. Let's assume it's not there, since it's very tiny, very small compared to the lower wick. So, we consider the lower wick, and treat it as a Dragonfly Doji, and the price could soar from here. Dragonfly taking flight, flying up here, right there. Alright, next, we move on to the concept of gaps or windows. This isn't a candle, but rather, a gap or a window, often called gap or windows. You might hear it as either gap or window. It's basically an empty space, a gap between price movements. For example, during a price rally, let's say today's candle closes and you see a gap appear the next day. This is more common in stocks, but not so much in the crypto market. In crypto, prices change continuously, so gaps are rare. In stocks, however, gaps are more frequent. If you've traded stocks, you might have encountered this. For example, let's say today, the market closes at 4:30 p.m. After the market closes, investors may reflect overnight. By the next morning, they decide to buy at a higher price. For instance, if a stock closes at 10,000 and the closing price is 10,000, something happens overnight, like a successful company meeting. So the next day investors buy at 20,000. They jump in and buy. A gap forms from here to there. This gap often signals strong upward momentum. It indicates that prices may rise sharply. The opposite happens during a decline. Let's say the stock closes here, and overnight, bad news hits. In the stock market, there's time to reflect overnight, unlike crypto, which moves constantly. So after bad news overnight, you might see the stock tank the next morning, opening much lower, and if you're lucky, you can sell here. But in crypto, there's no overnight reflection, because prices move constantly, so these gaps aren't as common in crypto. In stocks, though, you might see this situation frequently. You can see these gaps. If you see a gap like this, it's really something, a bearish gap. Bullish movement also goes up strongly, and people take this gap to form a resistance line. A resistance line means when the price drops, right, it drops, but when it encounters this gap, when the price goes up, this serves as a resistance line. The price will struggle to break through this level. Because they use the gap as a resistance line, the price will struggle to cross this line. When the price goes up, it hits the resistance line and immediately turns around. Now we move on to the next part. Now moving on to trading view, it can be used to apply this knowledge to real-world charts. Let me show you how. Now, for those of you, don't rush into investing. Finish this course before you start. This course only has 20 lessons. If you invest without certainty, don't rush. But if anyone really wants to invest, wants to start buying and investing, watch each video and immediately apply the theory and lessons to start making money. But start small, like $200. If you lose, then so be it. Consider it a $200 lesson. It's a cost, like tuition. If you lose, that's okay. But if not, there's another way to practice investing for free. Imagine you have $1,000. Then try to predict the market. Buy, for example, predict the market and see if you'd buy or sell. Buy and sell. See if you made the right choices. This way it's both cheap and educational. But it won't be intense, and you won't use all your mental energy. You need real money to fully engage your brain. You can only truly focus when real money is involved. Now, as you can see, we've covered a lot of knowledge so far, right? Do you remember this candle? This is a shooting star candle? Yes, shooting star or falling star. It appears at the peak of a price increase. Or this candle here. Hanging man, the hanging person, also appears at the top of a price surge. It indicates the market is starting to reverse. Do you see? Here, both the hanging man and shooting star are present. That's why the market is starting to decline. So here we're looking at Bitcoin versus USD on Coinbase, and the trading time frame is 1 day. Let's assume this, guys. You bought somewhere, I don't know, around this range. Let's say you saw the price drop down. From here to here, right, it dropped to this point. Or, to make it simpler, you jumped into the market and bought immediately, right, and bought at the price of 10,000, like here. The price shown here is 10,000. Okay, this video is old now. The price back then was 10,000, right? You jumped in at 10,000, thinking it would rise to 45,000. You bought it at 10,300. But if you knew how to read the chart and bought today, and then took this lesson tomorrow, the next day after learning this, you might ask, did I buy at the right time? Then you would see a candle here. A candle with a long body and short wick. You could call it a Marubozu candle. That means the price is still rising. Alright, moving forward, you'll notice another candle, called a spinning top candle. Right, a spinning top candle. You're unsure if the price will go up or down. So, we don't know yet, right? So, the decision is not to buy or sell here. Don't buy, don't sell, because the price might still go up. Who knows? The next day, boom, it rose again. See, it went up. Another strong rise. This is basic stuff, and you could consider this another strong Marubozu. So, the next day, you guys. Now you see the following candle. Ah, here's a candle. It's the hanging man candle with a long wick. Yes, a strong reversal signal. So, we should be ready. You can consider selling here, but do it carefully. Maybe sell here, but take it slow. Take your time, slowly. This is similar to the Dragonfly Doji, but take it slow. Slowly sell, okay. Then you see another candle. It's the shooting star candle, right. 2 days of signals indicating the market will reverse. Then the next day, you see, it's dropping here. So, you should sell immediately. Sell immediately at this point. Sell immediately. Then, if you look, you still made a profit from here to here, right. From here to here, you made an 8% profit, right. You bought here. You should sell here, but if you keep holding, thinking it'll go back up, then you'll be waiting for a long time. Right here, this is a clear signal that you should sell. But if you don't sell, thinking it'll go back up, it won't go up anytime soon. Look, it's dropping. If you don't sell, you'll be at a loss. From here to here, you'd lose more than 20%. If it drops even further, you could lose 41%. You see the numbers jumping between 41 and 42. Right, down 41%. See, it's dropping. Don't make the mistake of thinking that the price will go back up. Many of you, just like I used to, often make the mistake of thinking that the price will rise again. But that's because we don't know how to read the market. When the market looks like this, there's no way it's going back up. Exactly. Marubozu decline. Marubozu decline. And here we see something that could also be considered a doji, or even a spinning top. Showing indecision, right. Indecision between going up or down. Let's check if we see any more hammer candles. Here too, hanging man and shooting star. At the bottom of this downtrend, we can see that this here can also be considered a hammer. The hammer appears at the bottom and signals a reversal, right. So these are the basic candles you can use to analyze the market. You can decide whether to buy or sell. Just keep reviewing these videos, because listening once might not be enough for you to fully understand. You might not grasp everything at once, but if you listen multiple times and practice more, you'll become much more confident in your knowledge. We'll end the video here because making it too long can make it hard to follow. Thank you so much for watching. Remember to subscribe so you can catch all of the most helpful videos. And don't forget to click the bell icon so you won't miss any of my upcoming content. Also, make sure to click the link below to get access to free resources, including great books and tips for investing. Thank you very much. See you next time.